Right, hello, my name's Adrian Boothie, and in this video we're going to take a look at the use of commission with regards to trading Forex. Now, commission is essentially a dealing charge that's charged each time you place a trade on the foreign exchange markets. It's important to be clear at this stage that not all brokers actually charge commission. We've discussed in other videos the difference between market makers and really commission brokers. There is a difference. Market makers tend to have a spread and their commission, everything, all their costs are sort of bundled into a wider spread, whereas there are brokers, ECNs or STP brokers, straight through processing, whatever you might want to call it. Typically what they're doing is they're quoting whatever market liquidity they get, or they could hedge at, losing all their liquidity providers, prime banks, etc. Like an exchange, really. And then whenever you want to place a trade or buy or sell on that exchange, they would then charge you commission to do that, very much like you would get a commission on your stockbroker when they place an order through the London Stock Exchange. So that's really their pound of flesh for placing the trade. Whichever way you look at it, a widened spread or a commission, there is a dealing charge involved. And commission is certainly your dealing charge that you can get with some FX brokers. Let's have a look in a bit more detail. As you can imagine, the higher the commissions you get usually is based on service. So different brokers will charge different commissions and so on, and sometimes you might be wanting advice from a particular broker, in which case usually that will come with higher commission rates as well. Typically people don't get advice on trading FX. You normally get quite low commissions based on the fact you're execution only or you're doing your own trading. So how does it generally impact you? What is the overall charge to your account? Whether you're trading with a market maker and it's all spread, or whether you're trading with commission plus spread, that is effectively your charge. So if you add up your spread that you've got in the marketplace and you add up the commission, that is basically the spread that you have, or the charge that you have. What I mean by that is the higher the charge, so the higher the commission plus the spread the broker quotes, the more the market has to move in your favor before you're actually in profit. So if you're trading with a broker that has a 1 pip spread and a 1 pip commission, effectively that's 2 pips that the market's got to move in your favor before you're actually in a profitable or break-even position on that trading account. So let's go through a bit of an example now with specific regard to trading the euro dollar. Let's have a look at some commissions based on what you might get charged if you were trading with FXCM. There are a lot of different brokers out there, of course, and commission rates and spreads can vary, but here's a basic example of commissions on that there. So let's say we wanted to trade euro against the US dollar. And so we bought 100,000 euros worth of US dollars at a rate of 112.80. Simple enough, we're just buying 100,000 on our trading platform. So that would be a notional value of $112,800 worth of euros. Same basic thing there, so we're just swapping euros for dollars at that rate. Okay, if we want to work out the pip value, just divide that by the price. We can see that euro dollar is clearly quoted into the 4th decimal place in terms of pips. That would be $10 per pip. So if you wanted to trade 100,000 euros worth of dollars, so we're buying 100,000 euro against the US dollar, that would be a stake size of $10 per pip. So in other words, if the market moves from 112.80 to 112.85, that would be 5 pips. Okay, 5 pip move. If we're doing $10 a pip, that would be a difference of $50 on our trading account in terms of profit or indeed loss on that particular trade. Okay, so let's move on. So we're doing 100,000 euro US dollar. The commission that FXCM charge is $4 per $100,000 traded. You might get a slightly different rate if you're a sterling denominated account. It might be £3 for every 100,000 pounds traded, but that's roughly the same thing anyway. So commission, $4 per every $100,000 traded. So what would this transaction mean for you? Well, we're going to be doing 100,000 euros. Okay, so let's times it by the rate to work out the dollar value of the trade. Okay, $112,800, divide that by $100,000. times by $4 is our commission rate. Okay, so see what we're doing there? So it's $4 per $100,000 traded. It gives you the commission of $4.51. So $4.51 is our commission rate for placing that particular trade. Does that make sense? So effectively, we can look at that in pip terms as well, which is effectively 0.45 pips. Remember, here in this example, we're trading at $10 a pip, so if we're getting charged $4.51, it's effectively 0.45 pips as our charge. Okay, so if we're trying to compare like for like with commissions against a wider spread that some brokers may offer, then that gives you a rough idea about what we're looking at. So what would the overall cost be for a transaction like this? Well, it would be the commission. We've got to go into the trade. We've then got to go out of the trade as well. So we're going to do 100,000 in, 100,000 out effectively. So you're looking at roughly 0.9 of a pip. Okay, and then whatever the market spread happens to be. Now the quoted average with FXCM is around about 0.4 pips on the euro against the US dollar. The lower the liquidity, the varying spread there may be. So overnight the spread might be a bit wider. At major times of activity the spread might be tighter. So it just varies depending on the market and the time as well. So effectively the real cost on this basis would be 0.4 plus by 0.9 is 1.3 pips for that transaction. That is the real cost of placing that trade on euro against the US dollar. So if we were to do that trade from before, we would need to see the market move 1.3 pips in our favor before we're in a break-even position. Fortunately, that's not a lot actually, and the market can do that quite quickly. Let's have a look at the trading platform now. So what I'm looking at here is my sterling denominated trading account. You can see euro dollar. You can see the spread that's going on at the moment. It's a little bit tighter than the average quote, 0.3 there. And you can see the various different quotes that we've got down here. So for example, we might see dollar yen at a spread of 0.3 or 0.4 as well. Other markets, sterling yen with a spread of 1.7 and so on. A little bit faster market, lower liquidity there compared to the euro against the US dollar. So what that means is that you're going to get wider spreads. Not necessarily a problem for traders. You may decide that the speed at which sterling yen moves doesn't really make that increased spread or potential cost really a factor, but as I say, that's really down to you. Typically, as we talked about spread in another video, it may be that you'll save the wider spread markets where those dealing charges are comparatively higher for trading off higher time frames. That's really, as I say, down to you. But look at the time frames video as part of this course for further information about that. So in terms of commissions, we've got a couple of positions we've just shoved on here, really New Zealand dollar, euro dollar, etc. And the way FXCM do it is that they charge a certain rate for their most liquid markets and a slightly higher rate for their less liquid markets. We've got one of each here. Euro dollar, very liquid market, they're charging. In this case, we've got a sterling denominated demo account here. So effectively, we're just being charged £3 for every for our 100,000 that we've traded. However, had we have done a New Zealand there, we'd have been charged £4. It's less liquid as a market. Always worth having a look at your broker's website just to get a rough idea of quotes and things. You see on FXCM, it's got a list of the commissions that you'll get charged, and also it's got a list of the current spreads that might be available. It gives you a real good idea to find out whether you're getting a good deal from the broker. So a lower commission cost doesn't necessarily mean you're getting the best value, because the spread, the underlying spread that the broker might quote you, might not be as good. So for example, you might get a situation where the average spread with a broker is 0.2 compared to FXCM's 0.4. But if their commission charges are quite a lot higher, then it actually may not be in your interest to trade with that particular broker. So it's about looking at the overall position. Really, you're not going to be looking at a huge difference in those overall costs in terms of commissions, but spreads can be a big issue. FXCM, they are not a market maker generally, so what you're looking to do there is trade with them at their liquidity prices, what they get quoted, and then you'll get a commission charge on that one. So it is a little bit up to you as to how you want to do it, but I think FXCM quote a pretty reasonable offering in terms of commissions and spread charges.